Welcome.
This is another episode of the Defenders of Business Value podcast, a podcast where we talk about what makes a business valuable, learn the tips and tactics to increase your company's value that only veteran deal makers know. And now, here's your host, Ed Mysogland.
Welcome to another episode of Defenders of Business Value. My name is Ed Mysogland. I'm your host. And today, I'm super excited because I'm interviewing a guy by the name of Charlie Stanton. And Charlie, I have followed his work. I follow him on Twitter. I follow him, I get his newsletter, and he's a business appraiser, and he does a lot of estate and gift work. He does a ton of McDonald's, of all things. If you ever want to know what a McDonald's is, he's your guy. But one of the things that prompted me to say, you know what, why don't you come on the podcast, was that he contributed to a book. And the book was called The Art of Valuation by the Appraisal Foundation. And one of the things that has been a passion of mine is that helping business owners understand what value is. And so it really resonated me with Charlie having contributed to that book. It's really important that you as business owners understand what comprises value in your business and what creates value and all those steps that are necessary in order for you to make a valuable and saleable business. So Charlie has his practice is Stanton Valuation Advisors, and I'll have all the information in the show notes, but it was a fabulous interview with him. Such a wealth of knowledge, and I'm certain you'll get tons of value out of it. Well, Charlie, welcome to the show.
Hey, Ed, thank you very much for having me. Pleasure to be on here.
Well, it's a delight to have you. And before you came on, I kind of talked a little bit about you and your practice, but I probably didn't do it justice. So why don't you just go ahead and start from, just about, your practice, who you're serving and where you're serving.
Perfect. Yeah. So my company is Stanton Valuation Advisors, and we are a nationally or provide business valuation nationally. And we offer it to private owners, investors, operators, and we mainly focus on gift and estate tax work, which is typically work where owners are gifting shares of their business to trusts or to family members, or for whatever succession planning purposes they've come up with. Also do estate work when, the unfortunate matters happen when a business owner dies, and that needs to be valued for IRS purposes, but also focus on both buy side and sell side if necessary. Succession planning is something I like to help with owners as well, is helping them work on valuation 5 years or so before they want to sell, and kind of establishing the value and where they think they want it to go to. And also do financial reporting at times, ESOPs as well. And then, but I've worked in a range of industries as well. So I'm kind of a generalist in that sense, where I've done a lot of healthcare and focus on a lot of McDonald's franchises, but I've done pretty much almost every industry, it feels like.
Nice. So you and I, we were brainstorming on some questions, and the audience is predominantly advisors and business owners. There's a little subsegment of buy side, but generally speaking, it's owners and their advisors. And everybody wants to talk about business valuation. So I guess why don't we go back to the very beginning on why appraisers exist at all?
Right. Yeah, and I think that's I think a lot of people think the valuation only comes up when you want to sell your business or buy a business. But obviously, valuation is very important because the business is usually, for most owners, their largest asset they own. And so from a general standpoint, I think for any business appraiser out there listening, understanding the value of their business is important. And so appraisers exist in the world because we have the standards, the practices, the theories to apply valuation to a value privately held small businesses, right? There's no public market for those shares. So we exist, having that expertise in applying valuation theory. And we exist because there's a whole other world out there for valuation or for appraisers. So we do a lot of gift and estate tax work. I mean, there's a lot of strategies for business owners out there to transfer their interests to the next generation, to other people. And so that's a big part of it. There's also financial reporting. So there's a lot of reasons, like even lost profits, where business appraisers come in if under marital divorce or litigation type circumstances.
Yeah, way back when there was a guy by the name of Rob Slee, and he wrote a book. I don't know, you may be familiar with it. It's called Private Capital Markets. And one of my biggest takeaways from that book was that, the authority, like for example, you're talking estate and gift. Who's the authority? It's the IRS.
Right.
Divorce, it's that judge. You go to sell the business. All right. Who's the adjudicator of that value other than the market? So when you do that, and that's kind of where I'm taking the next question is, why is it important for the business owner to understand, their valuation is the first thing. And how do they know they're creating value?
Right. I think that's the biggest kind of point of it all is that I think one thing that business owners and just anyone in general kind of misunderstand is, as a business appraiser, we follow certain standards. And so one of the standards when we look at a business, I'll say, how are we going to value that business? Is it going to be fair market value, fair value, or are we going to look at some sort of strategic value for your business? And so from the buy side people, they're always generally going to be looking at some sort of strategic value. That's usually going to get you the highest price. But, for the IRS, they require fair market value. So that's a different type of appraisal that gets done. It's a willing buyer, willing seller. It's not this strategic buyer coming in. And so what that means for the owners, if an appraiser values your business on fair market value, it's not going to maybe be the highest value you can get. But if you say, hey, I want to look at maybe what a strategic price would be for my business, then we start really looking at transactions and premiums that people pay for businesses like yours, and then give you that kind of range to say, maybe it's worth X, but if you find a strategic acquirer, maybe they'll pay, X plus Y to buy your business from you. And I think that clarity is really important for business owners to understand sort of every business has a range of values. It's not just one value for it.
No, that is such a great point that you make. And sorry, I have a habit of interrupting the people I bring on. So
that's great.
I do apologize, but you're right. I mean, that range of value, depending on who the authority is, all those numbers can be right. And that's what I wanted you to talk about next. Not only how value is created, but also, how frequently am I supposed to do this? Often, someone shows up with a valuation in my office, and it's we got divorced 2 years ago, and now we want to sell the business. Here's my appraisal, and let's go. Mm-hmm. And we have the same conversation. That's not really what its purpose was.
Right.
But anyway, back to what I was, my original question, value is created, and how do you know it? And then how frequently do you measure that value creation? Yeah.
So I think one of the biggest takeaways is that it's kind of funny that value is really created from a really basic formula, and it really applies to everything, but for businesses, we would call it economic profit. And what the economic profit is, you take your profit effectively and you subtract out sort of the cost to achieve that profit. So if you raise $1 million to start your business and all your investors want to get a 10% return on it, well, you've got to at least make that, $100,000, income off of that $1 million to at least just break even. Now, people who drive value and create value over time are the ones who say, instead of getting a 10% return, I can do a 15% return. So my required cost is 10. And so the difference between the 15% and the 10% in theory is what is effectively an economic profit. And that is what's going to drive that value higher. A company that's really good at that is Apple Computers. I'd argue today probably is close to an 80% return on their capital, and I think their capital is pretty much cheap, and so it's businesses that can take in that capital and then reinvest it and keep growing. And I think it's understanding that to grow the business long-term and grow the value long-term, you have to continue to get a return on your investment, the money you're retaining in the business, reinvesting it and getting a return that exceeds generally your cost of that capital. Now, it gets a little hard with businesses because you don't always have an explicit cost. Like your debt would be explicit, right? You owe the bank every month, but your equity holders, for small businesses, it's a high return. A public company might say 8 or 9% return is sort of what our equity we want to get. But a small business could be a much higher return requirement just due to the risks associated and the size of that business. And I think it's one of those things where, depending on the type of owner you are, if you're looking to grow value, that's something you should be focusing on. If you're an owner that's maybe more of a lifestyle owner, you just kind of want to control your time, get an income, we all want to grow value, but reinvestment and what it takes to truly grow value might not be, your revenues might grow, but everything might be keeping up with inflation, so the true value of the business really isn't growing. Even though revenues might be growing and earnings might be growing, you're not necessarily increasing, value the value might just be continuing with inflation basically, which there's nothing wrong with if that's your goal. So I think with then the timing for owners, it's what your goals are, what you're trying to achieve, because some people are suggest get one every year, see if value's kind of growing every year. And you can structure a valuation where maybe if you want to start gifting, we can do the value in a way where, you can have that valuation not only tracking value, but for gifting purposes. Or in addition, knowing that value, if you want to do a liquidity event, go to a bank and try to do a recapitalization and pull money out if your business has value, there's just a lot of things that owners can do with it that, but it depends on how, what they're trying to achieve kind of effectively,
Yeah. Well, one of the things that prompted me to not only be a fan, I'm a fan from the standpoint of, all the credentials, so the ASA, accredited, senior appraiser, the CVA, the ABV with the the CPA Society, it's not, I don't want to say it's not often, but I want to say it's not often that you see a CFA out there doing business value work, I know, to me, the CFA is probably, one of the pinnacles of, command of the domain, so to speak. And so I guess the reason I bring this question up is because when someone is looking, it's not often that you see the CFA lopped in together with the other three primary valuation designations. So that's why I wanted you to talk about that. So can talk about the CFA and just the, what an undertaking that was to get.
Yeah. So the CFA stands for Chartered Financial Analyst, and it's for people who don't know, it's an internationally recognized finance designation, and it's coveted in the finance world because it's a grueling 3-part exam. It's self-paced. You basically sign up for it. They send you 3,000 pages to read. They say, good luck, and we'll see you in a year at the testing site. And all of this is fair game. And what it gives you is this massive understanding of the finance world. I mean, it covers every single topic in depth about qualitatively and quantitatively of pretty much everything in finance. It has emphasis on portfolio management and, business equity analysis. But to get through each exam, they're only given about once a year. I think they've changed it up since COVID, but when I was taking it, it was once a year basically. And if you don't pass, you've got to go back the next year and take it. And so it
Yeah.
weeds out a lot of people who aren't interested in it or wanting to pursue it. But it's a very challenging exam to go through. And so it gives a really strong financial foundation for anybody. I mean, any financial topic you hear about from a CFA perspective, you're like, you might not be an expert in it, but you know about it. You have an understanding of it, and you can always reference your textbooks if you need to at least, handle that kind of issue. But it covers everything in finance. So,
congratulations. I mean, that
Thank you.
is such a huge undertaking. And so like I said, the point of the question is I want listeners to, if they see that designation, that should not exclude.
Yeah.
anyone
And you're
from
right.
that.
It's not common in the valuation world. There is the ASA, the ABV, and the CVA, excuse me.
Mhm.
And those are great because those you are required to have specific valuation experience to get those.
Mhm.
And all of those, I would suggest for anybody out there, if you are looking to hire an appraiser for something, especially if it's IRS related, you want somebody with that background in valuation. I used to have the ABV. I'm actually going for the ASA right now. So try to get that within the next year or so. But all of those require valuation, and they require people checking to know you actually know what you're doing, so to speak.
Well, and now it's swinging from the top to the bottom. Now we're talking valuation, and it seems as though valuation's getting more and more commoditized. Mm-hmm. And I'm a fan of valuation. I'm not a fan of, the best way to say it, I'm not a fan of the turn and burn, just dump in a bunch of information and, I'll have your appraisal done, it'll cost you $500. It'll be done in 3 days or what, pick the number. I mean, and so, I guess the reason I share that is, what's the big difference? And when I talk to people about, let's do some market analysis, let's see what the market's paying for companies like yours. And, it's like, why is it so in depth? Why is it costing me so much? And so can you talk a little bit about, kind of the commoditization, and then, just what a true appraisal really is?
Yeah. I think the commoditization of the appraisal business, it comes from the idea that you think it's just, here, let me give you my most recent P&L and a balance sheet. And from that, I want you to tell me what my business is worth. And I'll tell you this, I have valued many different businesses, hundreds and hundreds of businesses. And I valued, let's go to this, the McDonald's that I valued. Not every McDonald's is the same. So they are all not going to trade at, 0.5 times revenue or some sort of, or 0.8 times, whatever, they're going to trade. I've seen some trade between 0.2 times revenue all the way to 1.3 times revenue. It's just a range. And what that gets back to is that an appraiser, yes, we look at the financials of your business, but it's the qualitative aspects of that business that are really what we dig into. And those, I don't think, just get captured right away from looking at the income statement, the balance sheet, because you could be a leader in your industry, and we're not going to just necessarily pick that right up just by saying, oh, let's look at the last 12 months and see, or try to do some sort of forecast. Plays into, risk and growth and all that.
Well, it's funny you say that because I was squabbling with a business owner, and he's saying, well, look, my earnings margins are so high, I'm elite. And now granted, it wasn't always that, but it was, in the last 12 months. And I'm like, well, this may be the outlier, somebody, let's line up a few years at this, and then we've got something to talk about as far as the eliteness of your business. But yeah, that where I'm heading with is that had somebody put it through the churn and burns, it would have rendered to me probably an overstated value, and that company would never sell.
Yeah.
So you bring up McDonald's, and that kind of segues into my next question. So, like, and I don't know. I guess where I'm going with this, I want to know from when do you need a generalist versus when do you need a specialist in the appraisal world? I'm talking to, a woman, and she was saying, look, I've got all kinds of people in my industry that do valuation work. Why would I use someone like you? And so I'm just curious to know what's your answer to specialization versus just a generalist that can use the standards and use PAP and develop into a defensible analysis.
Right. I think what my answer to that is generalists can offer, one is, I would think any appraiser, if you're really not sure about the specifics of an industry, they should not take the engagement. If it's
that's a standard, right? That's
right.
That's USPAP standard.
Right.
If you're not competent, you should. Yeah. Okay.
And so I think don't. Right. And so following, again, it's a good reason why standards are important for
Right.
to hire somebody with those qualifications. But I would say, if you're not in it, if you're not really familiar with that industry, I would say, stay away. And I would ask them their familiarity and try to gauge them. If you're hiring an appraiser, try to get their sense of it. But I think what generalists can bring to the table is that they've had exposure to so many industries. And so when you have that external sort of experience, I think you can kind of draw from those industries and help build context around the industry we're looking at. Because sometimes it's really, really hard to find somebody who's an appraiser in that exact niche. I did an appraisal I've done a lot of tech companies, but I did one for a company that they basically outsourced software engineers to other software companies. And so it was a hiring business where, if a company had 80 engineers and they needed 10 more just to fill in some gaps for 6 months. And that's a really, really niche business. I mean, it's almost, there's no NAICS code for it. There is nothing, there's probably 100 of those. So you're never going to find somebody who's an expert in that industry. But that is similar with the staffing business. That's really what they are. They're just in a really niche staffing business. And so I valued plenty of staffing businesses and understanding sort of the economics, the dynamics that drive those drive those businesses.
I get it. So you didn't like this question, and you said you were never asked it. But what are the common mistakes that business owners, make when they're preparing or they're going through the appraisal process? And if you can't answer it, I've got a couple for us.
Well, no, actually, I like the question, and I'm glad I've never been asked it. I think it's a great question. I think, and it gets back to what we were talking about, I think owners tend to they almost commoditize their own business. Like, hey, here's a balance sheet, income statement, value my business. And I want to know everything about your business. I want to understand not only who are your customers, who are your suppliers, what are your relationships like with all of them? What are your operations like? Who is handling customer complaints? Who's handling all these issues? That gets to key man type issues within the business. But I want to know everything, within you. How are you marketing? How are you advertising? What are you doing to differentiate yourself? And so I like to have, hour-long, in a perfect world, have hour-long management discussions with people, where you come into some owners and it's like, I don't know, just tell me what you think it's worth. And I'm like, you're almost commoditizing yourself, because
that's interesting.
I need to understand, if I could look at a range of multiples and I can financially quantify why you're, you should be a certain multiple, maybe the high end or the low end, but maybe there's factors in there that, change
Yeah.
that, that maybe you get warranted a higher one. Maybe you're the only person in your town that does what you do and nobody else can go there. And for whatever reason, you've killed the competition and there's a potentially significant value there. And so I think for owners, it's definitely, if someone's appraising your business, give as much info as you can, because I think it's helpful. And if you're an appraiser out there and you're not asking for all that info, then shame on you. So
Right.
I'll be interested to hear what you say or you think.
Well, my biggest beef is don't try to influence me. Just, that it just rubs me wrong. The data is the data. And I mean, there's a certain level of subjectivity that 31 years doing it, I have a pretty good idea of what I'm talking about. But you sitting here telling me, my earnings stream is off or and just arguing, at each step of the way that you know more than what you've hired me to do.
Yeah.
And and I'm on sell side stuff. So I spend a lot of time, and this is kind of going into the next question. I spend a lot of time in the market approach looking for data, whether it's our own, we've done 2,200 deals, or I'm out on the databases looking for deals that I can compare and say, this is the behavior, that this group, exhibited toward this type of investment. And here's why you're comparable to it. And I'm going to apply something similar to you. And that's, like I said, the next question was, I've always said that the income approach is for buyers. Don't show up at my doorstep if you're selling your business with a discounted future earnings or capitalization of earnings. I'm looking for deals. I want to know, what they're selling for. So that's my question. Do you agree or disagree? Because I'm okay with you if you disagree.
Yeah, I think I think my thought on that is I think you're exactly right. I think the income approach is if you're buying a business and you're not doing an income analysis, shame on you, right?
Right.
And so I
100%.
think you're dead on with that. Because I see a lot of people, especially like on Twitter, really talking about multiples and, we can buy this for an EBITDA multiple. And it's like, are you doing like some sort of full cash flow analysis? Like not only income, but working capital investments, CapEx investments, are you going through that whole process? So yeah, I would say for anybody who's buying a business, focus on the income approach, then reconcile that back to some sort of whatever the market multiple is, because the market multiple might be too high based on what you think you could probably do with the business, so maybe walk away. And then I think you're right. I think from a business owner selling it, the cash flow, if you're buying a business, you're going to be a controlling owner now, which means you can make controlling owner adjustments. Yeah. And so that means you're going to change probably the expense structure. And so I think focusing from the seller standpoint, right, it's the multiple of trying to figure out, are you a strategic buyer? Are you my competitor? And now you're wiping me off. So now you can go raise prices 10% on everybody, for instance,
right?
And wipe out my entire accounting department. Now I know your costs have really gone down and you're going to acquire this revenue. Like I know you could definitely focusing on that multiple side is saying, look, I'm not even going to do a DCF for my son. I'm just going to say, look, the multiple, I'm going to have you at the higher end of that range for multiples because I know what you're going to potentially do with the business.
Yeah. Well, I mean, I always felt that the buyer has different risks. If you think of the pool of buyers and you develop your discount rate or your cap rate or whatever, that's quantifying risk. And I think each person has has what they perceive as, the company specific risk more so, if you're doing the build up or whatever you're choosing to do. You and I, looking at the same business, probably have different risk tolerances, depending on our backgrounds and our experience. And that's the only, that therein lies the only reason I I shy away from it is because I don't think, I can say, all right, this is what a normal person would do, I guess. But I don't know whether or not, is that kind of over or understated? So anyway, that was just my take on the income approach.
Yeah, no, I think that's a really good, point too, because it is a risk. I mean, business valuations come down to risk and growth.
Right.
And so those are like two of the major influences. And you're right, the risk profile of the current owner is going to be different than the buyer. And they could be, higher or lower just depending on who the buyer is. So
yeah,
you're right. That's gonna change value. And that gets back to the point that there are multiple values for a business.
Right. And again, I failed to mention, and you brought it up, is the growth. I mean, you and I may be looking at the same business and looking entirely different from growth. So we agree on our earnings, we disagree on our risk, and we disagree on our growth. So 2 out of the 3 drivers, or the components of value, you and I may differ in how we see the same business. So that's
right.
Again, but at the same time, if I'm a buyer, yeah, I am spending all of my life on that income approach. I don't care what any deal guy or anybody else has said that business is worth, because that's where the rubber meets the road.
Right.
All right. So you're an author too. That's so you contribute to the art of valuation. So I got an email and I was like, I had no idea. So let's talk about that.
Right. So the Appraisal Foundation, which is for the listeners out there, that is basically a group that basically runs, I don't know how else to really say it, but USPAP, right? Which are basically the standards for appraisers. And they're definitely nationally recognized. I can't remember if they're internationally recognized, but for every appraiser, real estate, gem and jewelry, business valuation, machinery and equipment appraisers, all of them, those standards for those professions fall under, USPAP sort of guides those standards. And so they were coming out with a book called The Art of Valuation. And I submitted an article to be considered for it, focusing on the story in basically the story in valuation, or how every valuation tells a story. And I don't know if you've gotten it, I'll send you a copy for sure. If you don't have it, but my subject matter basically is focusing on, I come across a really interesting study by an author named Kendall Haven, and he studies brain science and storytelling, and effectively, which is coming really talked about now, but all of our brains are hardwired for story. So if I gave you a bunch of facts, most of the time people are still going to create some sort of story. And I think appraisers approach evaluation saying, I'm going to be very objective and fact-based. And they're misunderstanding that when someone is reading that report, or if you're communicating that report to your client, they're going to read their own story about what you're saying, And so it's a concept of that, your brain, your mind is going to piece together a story. And if something doesn't make sense to your listener or reader, they're going to fill in gaps or put in their own understanding or whatever to make it make sense to them. And so there's like 8 essential story elements that you have to tell. And it's like, you have to have a character, and it's really common storytelling things. Sure. But once you hit those 8 elements, your brain has sort of digested what it needs to fill in a story. And so I think for any appraiser, really anyone doing, especially in valuation, because valuation is a great way to trick, or people could trick themselves in doing it, right? They tell themselves a really great growth story. We're the next Amazon of whatever, you're like, oh, we're going to grow, be huge,
Sure.
Nothing else lines up with that story,
I get it. It's funny. It's funny you say that. So we, like years ago, and I'm saying years, but it's probably gotta be 5-7 years ago, I would prepare these glorious reports. I mean, they were just awesome. and and I don't know if you've ever handed somebody your appraisal. They either look at the first page or they look at the last page,
Right.
and all that work that you did is just evaporated. So I appreciate the storytelling, and what I did was I put right in the development of the discount rate. I wrote, if you read this, I will give you $100, no questions asked.
Oh, I love that.
And no one took me up on it for an entire year.
Oh, wow.
So
I'm stealing that from you.
No, so what I did was I changed our format. So now I PowerPoint it, and I say, all right, basically the same storytelling. And I'm so glad that you did this, but the storytelling is like, look, I'm going to go through this, how I arrived at the value. And as we go along, I want you to ask as many questions as you want. So when you leave here, you know exactly what I did and why I did it. And then I'm going to hand you the report, and it's going to say the same stuff. Yeah. So anyway, I'm glad.
Well, I think that gets back to, because you had asked earlier, and we kind of touched on it, was like, what is an appraisal report? And so when you do a full value, there's generally like two types that, based on standards, you can kind of do. There's a full valuation, then there's like a limited analysis. And so for a full valuation, I mean, we're going to do a deep dive into your background, the economy, your local economy, the industry. We're going to pull benchmarks for companies, compare your business to your benchmarks based on profitability, returns on equity and capital, leverage, liquidity, and take all that information and synthesize that using the income, market, and cost approaches to develop a value for your business. And I think many business owners, is because one, when they get the reports, they can be voluminous in stature. So I don't get them for not wanting to read it, but there's so much information that we pull from, and hopefully appraisers make it relevant. A lot of times appraisers will just dump in all this economic data and really has no relevance to the business. But trying to tie back all these important data points to your business and what's influencing your business, where we think it's going, because there's always the internal view and the external view. And the internal view is, hey, my business is going to be great and it's going to do well. The external view is that, maybe today there's war breaking out in the world, and there's, cyclical decline in certain industries that are adjacent to your industry. And maybe other things are happening that we think achieving higher growth might impact your business, for instance. And so we'll always explain everything out in detail. And so I think I try to always walk people through all these kind of key insights. And then especially the benchmark analysis, because it's like, I think from an appraiser standpoint, you can offer a lot of good insights for owners to say, you're lacking in this area, or something's here, or your cost structure is just a lot higher than the industry, what's going on there, or, whatever the case is. I think appraisers have a good opportunity to sort of offer advice to owners. Yeah, no, that's good.
So the future of business valuation, what's your crystal ball say? What do you see coming down the pike with business appraisal?
Okay. So probably the elephant in the room is AI. I think, and I say that because I think AI is probably going to take over everyone's job at some point, to a degree, though. There's going to be parts where it helps. But I think for business appraisals, I do see more and more of these sort of websites you can go to, put in your data, it will spit out a number. Anybody who's done that, I would really advise against it, because it's not really understanding your business at all.
Yeah.
And then I think as the industry continues, I think for me, for doing gift and estate work, that will be here forever. And that industry will be around as long as the IRS is around, will be around. And so, but I think for appraisers out there, understanding that you know, or I guess for business owners is not, that there are going to be easier tools to come out. There might be some sort of AI tools where you can answer some questions, give some data. I wouldn't doubt seeing that stuff, but I think having a person who can back up what they're saying and why they're saying it and give a logic and a rationale will always be important. But I think the industry in general is going to have to get to a point where it's not just like you're saying, the commoditization. It's offering the advice and then trying to give more, as a consultant to a degree, saying, look, here's what we've come back with. Yeah. And I think a lot of people don't do that. They just say, I'll give you your value, right? 3 days, $500, got you your value. And what do you really have from that? Probably not a lot.
No, I get it. And that's, I have, Chris Mercer from Mercer Capital wrote a pretty, I don't want to say scathing. That's probably overkill. But I mean, some of his thoughts on the future of the profession was pretty, I don't want to say alarming, but I think I think that people like you are getting harder to find. You know what I mean? That I don't know if there are as many entrants into the profession as there were,
Yeah.
But, and as we're kind of wrapping up, one of the things that I always thought about was, anybody, if you just do any kind of valuation, at least you're starting to think about value.
Yeah.
And so I was never, I didn't care whether you went to Value Adder or whatever that is, or Biz Equity or whatever. At least you're starting to think about it. And it gives me the opportunity to say, yeah, you know what, this guy's full of crap, or this online tool is full of crap. Here's your slider and just do this and this and this, and it'll give you a great valuation. It's not like that. I think the biggest for me, I think it's who's going to translate that. And I think that's what you were talking about with AI, that, AI is probably going to help all of us.
Yeah.
But you're still going to need somebody to translate. And you can say, all right, AI, translate this into, help me understand as if I'm a third grader.
Right.
You're still going to need somebody with boots on the ground.
Yeah.
You're still going to need somebody like you.
Well, and that's why the book that I contributed to, they call it The Art of Valuation, because we look at it as an art form. It's not an exact science. And if you're inputting stuff into a website and spit out a number, that makes it feel like it's just this, very basic formulaic process. And although we do use a lot of formulas, there are a lot of qualitative factors that need to be considered and really understanding the business, understanding the industry to give you, a reasonable, sensible kind of valuation, especially for whatever purpose that is.
Yeah. So one of my last question, and it has been that way for 100 episodes now, is what is the one piece of advice that you would give our listeners that would have the most immediate impact on their business and value? What would it be?
Okay. I know you asked that, and I love that question too. And I've been thinking a lot about that because I listened to you. I've been an original listener of your podcast too.
Heck yeah.
So, I love that question. And also I want to say congrats. I don't think I said it, but 100 episodes in. So that's a big deal.
Right.
Good job.
Thank you.
So I would say this is, I've been toying around with what I want to say. But I would say one of them is, it comes down to risk and growth are huge impacts to value. Higher risk means generally a lower value, let's say. And I would say, let's focusing on that. One of the big things I come across a lot when I do like succession valuations for business owners is there's so much key man risk in the business. You talk to the owner, they say, I'm the one who handles all the sales. I'm the one who handles all the problems with customers. I'm the one who knows how all the systems work. And I would recommend to any owner is assessing that risk in your business as key man risk and trying to limit that. I know you had the lady on who did the SOPs for your business,
right?
And so it's getting simple as getting your SOPs in. It's simple as maybe giving up some control getting a salesman in there to help this, or maybe it's hiring, maybe an extra, like getting a more of a strategic CFO in there or something to help kind of plan out the business if you feel like you're the one strategizing for the business or something. So there's just a lot of instances where I feel like that is, in a small privately held business, that is one of the biggest risk factors that is really hurting the business. And so streamlining that and getting that off your plate as much as possible, I think, is something that actually tremendously helps value.
Yeah. And the funny thing is, you would think, because that's one of the I don't want to say the standard ones, but it's it. You are the business, and you can't be the business and maximize your value.
Yeah.
You can get a decent price, but as far as getting the most for your business, I'm not certain you're going to get there.
Right.
All right. Well, Charlie, how do we connect with you?
Oh, great. Yeah. So I have a website. It's www.stantonvalue.com. That's my valuation company. And then I'm pretty active on Twitter. It's at Capital for Value. And then I am on LinkedIn under my name, Charlie Stanton. I'm not as active on LinkedIn. I don't really use it as much, but I think I might. And then I also have on my Twitter link, I'll have a link to a Substack I write for. I like to look at publicly traded companies as well and talk about that. I think there's a great amount of information to pull from those. Since everything's available, there's a lot to talk about for every type of investor and owner. So you can see me on those resources.
Okay. And as far as the art of valuation, is that being sold by the Appraisal Foundation, or is it on Amazon?
It's being sold by the Appraisal Foundation on their website. I'm not sure if it's on Amazon, but the Appraisal Foundation has it on their website.
Well, I'll make sure that there is a link to wherever it is. So, Charlie, this has been awesome. I have enjoyed our conversation immensely.
Hey, I have too. Thank you very much for having me.
This was another episode of the Defenders of Business Value podcast. For more episodes packed with strategies to increase the value of your business, visit defendersofbusinessvalue.com for show notes, transcripts, and free tools to start you on your journey. Subscribe now so you don't miss any future episodes.